We're not seeing extreme risk at this point or extreme volatility. It's more of a rotation under the hood. At the same time, it's not like they've gone through a 20-30% sell-off and are washed out and are showing screaming buy signals. So we're not seeing a washed out market. It's more of a neutral market. So we're positioned on target right now overall. This is the Realize Your Wealth podcast by Aretec Wealth. We want you to be wealthy. We want you to feel wealthy. We want you to realize your wealth. All right, here we go. We're back. It has been a smoky week here in the city. Very interesting weather. Markets have been a little bit softer this week, which we wanted to talk about and address and get into it. Maybe that's the wildfires or something like that. Maybe it's related. The sun was blocked out, I think, on Wednesday. It looked like it was the apocalypse or the end of the world or something like that. But it does look like it's clearing up today out there. But how you doing, Greg? You got the golf shirt last week. We see you're looking good. You're looking sharp today.
Yeah, I was excited when I got the golf shirt. I must say it did not help my golf game whatsoever when we went golfing last week. You were Will. You were pretty good. I'm a once a year golfer, and when I was out there, I was thinking to myself, I remember being a little bit better than this, but you were actually pretty good out there.
Yeah, I don't know about that, Greg. I mean, I think you're being generous to me. I swung the clubs a few more times this year because my son Connor's gotten into it a little bit, so he wants to go to the range. So I think I worked out a few kinks in the swing beforehand, which just meant slightly less lost balls. But no, it's good. The golf shirt looks good. That's 2026 model. So you're looking good. You're looking sharp. But yeah, no, it was good fun to get out there, and glad to see the weather's clearing up here. You headed up north for the weekend?
We're heading up north. We're keeping an eye on the air quality because apparently it's supposed to get worse before it gets better. And
we're
going to be in. Yeah, I don't know. I'm not a meteorologist, so don't take that as for sure. But yeah, ideas heading up north. Hopefully the air cleans out. So yeah, what about you? Are you guys heading up or staying in the city?
Yeah, we're going up for tomorrow and heading up there, and I'm gonna spend some time up there just because Connor's nice. Up there for a camp as well, so it'll be a good week to spend up there. But anyways, looking forward to getting in things today, diving into it, because it has been we're getting a little bit of turbulence here in July, so interesting to see. If we look back sort of the start of summer, mid-June, in that time frame, markets were pretty calm. Everything was moving along, humming along, and now we're getting a little bit of a tale of two markets where the NASDAQ and sort of the high-tech growth areas that were driving the markets for the last few months coming out of March and the whole situation in the Middle East have started to correct. So it's got some implications for the markets, our portfolios. So we wanted to dive into that and talk about that a little bit today.
Yeah, and what you're seeing, Will, you mentioned there's a tale of two markets, and you're also seeing a tale of two kind of broader themes. The Iran war and then interest rates, inflation, they're kind of coming to a little bit of a head, which is causing turbulence. So I guess just from a high level, Will, this past week or so, it's been a little bit choppy. Has it been driven by one particular thing, or has it been a few different catalysts?
Yeah, I think the biggest thing you're seeing, I mean, if you look the last few weeks, the NASDAQ's off somewhere in the 5, 6, 7% range overall, but some of the very high growth areas of the market and some of the areas that were really the market leaders and had a lot of momentum have pulled back. So semiconductors is an example. Some of the other related AI stories and trades, anything that was kind of plugged into that AI trade, which we've talked about for a while, that's a potential risk or a potential problem that's out there, that those areas of the market start to start to pull back. So anything really related to that AI trade has sold off. Some of the things as well, the commodities that have benefited from that or have fed into that. Some of the related energy names and metals names and different pockets of the market. So a lot of those areas that were the main momentum and leadership names have started to shift. So we've seen that at least if anything, a pullback and a bit of rotation. What's been a bit of relief though, as we've talked about, is the value pockets of the market and the more traditional areas of the market have really gone and continue to hold up well and have continued to rally. So most of what we're seeing really has gone on under the hood, where these more value kind of dividend, more conservative areas, call it, of the market have held up pretty well. The more growth areas of the market, what had that momentum has started to peel back. There's some other related trades and implications there, but that's at least the really high level story of what's going on in the market, say this week and the last few weeks.
Yeah, and the Nasdaq has been leading things lower. I think you mentioned it's 5 to 7% off its high. Some of the steam is coming out of the AI and the tech trade, but just by comparison, Will, how's kind of like some of the more value indices holding up? So like TSX, Dow, International overall.
Yeah, they're holding up fine. I mean, there's a little bit of ripple through in there, but the more value indexes are fine for sure. So, I mean, one of the things too, like energy, some of the areas that we've added to the last while have been more focused on value, and energy is somewhere we bought on the pullback, and so you've had renewed issues and tensions, to say the least, in the Middle East. So when you're looking at July, areas like energy have rallied, so that helps the TSX. Financials, which we've got a good healthy exposure to as well, has rallied. So we've got a good balance between some of those growth and value areas of the market in the portfolio. So growth right now is taking the backseat, at least for the last month or so, and values leading the charge. And it kind of ties in with that inflation and interest rate story and some of the other things we've been talking about the last few weeks for sure.
So given all that, Will, is kind of the idea and the thesis at this point. So you've had tech pull back, you've had value kind of hold on okay. Is kind of the idea over the next little while is to continue kind of moving more towards value at this point?
Yeah, I mean, I think that's where we're seeing the strength right now. I think that longer term story is still intact. I mean, the other thing I would think about is that there's still plenty of pockets in that growth area of the market. Some parts of it have now pulled back 30%, and then the value stuff is hitting all-time highs. Like, think areas like banks are all really overbought, really overextended, bumping up, I think, well beyond fair value. So I don't know if that's necessarily the point at this place in the market I'd be chasing. But you look, it's under the hood of what's going on, is that a lot of those growth names have sold off, but you've also seen a little bit of a counter rally. I think that comes from a lot of the leadership in the market, what's been driving it up, what's been driving it higher. So some of the areas even that are rallying here, like we've had some exposure to areas like software, like Microsoft, names like that, which have actually been on a pressure, but we're seeing some at least renewed opportunity. Things like defense stocks as well, which interestingly this year have come under a little bit of pressure, and we're seeing them start to rally. So I think one of the things you're seeing here is some of just those weaker pockets of the market are starting to get some benefit of the rotation. So some of those leadership areas, money's coming out, flowing to some of the weaker areas of the market. So it's just more to say that's a little bit of what's going on under the hood here.
Yeah, that's interesting. And you mentioned it a couple times, Will, and just to add to that, so renewed tensions in the Middle East right now, how is that impacting markets, if at all?
I mean, I think the biggest thing, well, I guess a few things. So one, oil prices. That's somewhere we added to a few weeks ago. Having more oil exposure and energy names on the pullback post war. So we certainly didn't get that initial bump, but a lot of those names came down and pulled back pretty significantly and are still There's a lot of reasons. There's still potential tailwinds behind these energy names. So you're seeing higher oil prices now. Energy names are starting to go. The other thing that we are seeing is that just feeds into the inflation concerns. And then it feeds into interest rate expectations. So even though some of the inflation numbers came in a little better than expected, say, there's still concerns from a lot of investors that inflation's not going away. Interest rates could be going higher. Are we going to see Fed rate hikes later in the year? And that feeds into the tech story. That's similar to what we saw in 2022, that if we have that inflation creeping up, interest rates start to go up. That's gonna lead to a reckoning or potential reckoning in the Nasdaq, and so we might be seeing some early signs of that overall. But I mean, one of the nice things in terms of Nasdaq and AI exposure and the correlation, say, of the S&P 500 to technology, it's like 50%, where it's tied into the AI trade, and the Nasdaq's even higher. We're more in the range of 15%. Some clients maybe a little bit higher, some lower, but we're a lot more closely, at least in terms of technology exposure, we're more closely correlated with the TSX as opposed to the Nasdaq or the S&P 500 when it comes to the technology trade. And not that we don't want to have some exposure, not that we don't want to participate in that, but we can just see how volatile it is. I mean, semiconductors, an example, which have been leading the charge, have done incredibly well over the last couple of years or more than that. But when things are moving up that far and that fast, we look back 2-3 weeks to sort of late June, early July, they were getting pretty overbought and overextended. So traders are coming in, pushing those down. That doesn't mean it's the end of the chip trade and the semiconductor trade, but it just shows you how much risk, how much volatility there is in that. So that's a relatively it's going to be a good position for us, but it's relatively small in the grand scheme of things.
And the interesting thing about the inflation and interest rate story, so going back to the war in the Middle East, so inflation came in softer for the month of June, and a lot of that had to do with energy prices coming down pretty significantly from the highs in April and May. Obviously, energy prices have started to move higher in July. So point is that that war in the Middle East is really going to kind of impact inflation and interest rates, and it's really going to be kind of a month to month type of thing.
Yeah, we gotta keep an eye on that. Investors need to keep an eye on that. I mean, I think the general sense and feeling that you get out there is that inflation is not going away. It's hanging around. I think how people feel out there in the real world is that inflation is sticky and it's going to be hard to get rid of, and it's probably going to take either some action from the Fed or some sort of slowdown in the economy to bring it back down to the pre-COVID levels. So I think that's going to be one of the stories this year. It's going to certainly tie in with the tech trade. The other place that we see is when you talk about gold and precious metals, is there's certainly a correlation of that. So that's one of the things that we like the gold trade, like the long term positioning and strategy. The challenge is a little bit here. It's become correlated with the interest rate story, the inflation story, the U.S. dollar story. So it's something where if you're starting to see signs that interest rates might go up, so rather than gold acting as a pure, say, inflation hedge, it's that, okay, if inflation is creeping in, that means that interest rates might go up. That means the U.S. dollar might go up, and that starts to put demand on U.S. dollars and relative to gold, which really its positioning is as a reserve currency or alternative or secondary currency to the US dollar. So certainly we like that story longer term, but we've seen 2026 that's come under some pressure. So gold's lagged a little bit. Gold miners, they were doing really well earlier in the year, and then ever since new Fed chairman Kevin Warsh came in, more hawkish tone from the Fed, more or less. that's kept gold under pressure. So I think that's somewhere to watch, somewhere to keep an eye on. It's not entirely that way. Like we're seeing gold, at least we're filming this Friday morning. We're seeing gold up today, tech's down. So they're not one to one correlated, but there's certainly similar stories in driving that. So that's something we're watching. The gold story, the precious metals, the commodity story, certainly an area we like longer term and strategically from a positioning standpoint. That's an area that there's a lot of things feeding into it. The natural resources as well are good for Canada, good for the Canadian market. And I think what we're going to see in this environment is a longer term bull market for commodity prices, and more so that super cycle that we talked about couple months ago or so now. So very good for all those areas, whether it's energy or precious metals or base metals or agriculture, and we've got a healthy amount of commodities exposure, but there's certain parts of it which we're seeing some correlation to what's going on with inflation, interest rates, even technology to a degree. So that's something to watch for sure.
And to that point, well, the TSX has been one of, if not the best performing North American indice this year, just with the exposure to commodities, which is good, obviously, to see. So, just a quick question. Well, we've talked about tech, kind of chips, commodities, gold, precious metals, energy, but just overarching in terms of the strategy right now, are we a little bit more invested? Are we a little bit less invested? Are we kind of at target? Like where are we kind of at big picture?
We're close to on target. I think the place at least pure equities were maybe a little bit underinvested, but we made up with that with some more commodity investments. So if you look on our portfolio reports, and we have pretty good exposure between the gold, precious metals, and then some of the commodity funds, which are tracking oil and agriculture and base metals and areas like that. So we're close to target overall in terms of we're not overweight, like say for a growth client. When you add in the equity and the alternative exposure, we're close to 80-20 overall, maybe a little bit under that, depending on the exact investor and mix. So we're more in a neutral stance here overall, which I think is the right positioning for this market. We're not seeing extreme risk at this point or extreme volatility. It's more of a rotation under the hood. At the same time, this is not certainly the markets have, it's not like they've gone through a 20-30% sell off and are washed out and are showing screaming buy signals like it's March of 2020 or April of 2025 after the tariff crash. So we're not seeing a washed out market. It's more of a neutral market. So we're positioned on target right now overall.
Yeah, so I guess just there's a lot that happened this week. Is there one thing, Will, that investors should kind of take away from this week, or maybe one thing that they should think about heading into next week?
Yeah, I mean, I think what we're keeping an eye on is that the tech trade and the Nasdaq trade. It's already gotten pretty quickly in 2 or 3 weeks. Some of the pockets of there, it's gotten pretty extreme, and I think we're keeping an eye on that. We're watching it. One for risk and risk management, but I also think there's an opportunity set and potential opportunities when you're seeing pockets of the market sell off. So to me, that's what's really driving this is a little bit of an under the hood rotation in technology. At this point, it hasn't rippled into other areas of the market, which is actually kind of good. It's more of a under the hood rotation. So that's what we're watching, the technology story, which obviously ties in with inflation and interest rates and all these other pockets of the market, the US dollar, gold, everything we talked about. But right now, it's technology that's leading the charge here.
Yeah, and that's the sector that we've talked about. It's seen the most kind of pullback so far this year, while the value stuff has held in. So, anything else, Will, just as we finish off, that you want to add?
Look, we're sticking with the process here. We're hanging in there, managing things, governing the portfolio accordingly, and ultimately, it's all about we want you to be wealthy. We want to see things moving along, growing, moving in the right direction. We want you to feel wealthy, enjoying your money, enjoying retirement, enjoying life, enjoying the summer weather when the smoke clears away, hopefully, and We want you to realize your wealth. That's what Aretec Wealth is all about. That's what we're all about. So enjoy the weekend, everybody, and we'll be back with you next week. Thanks.